Hey, it's Mike Lynch with AmeriFirst Financial. It's Monday morning, and it's time for your Monday morning mortgage update for the week of October the 17th. Hope you all had a great weekend. Love this cooler weather. So let's dive right into it and talk about last week and what's going to happen this week. So last week, big sell-off in the bond market. Mortgage-backed securities were down almost 100 basis points. So from the day they started on Monday and when they ended on Friday, 100 basis point sell-off. Let's just go to the charts. I want to show you really what this looks like. So this is a representation or a chart of the trading of mortgage-backed securities in the bond market. I've shown you this many times. Each one of these bars represents 1 day of trading. You can see as I move my cursor, you can see how the days change. And we call these candlesticks because you can see the little wicks on these things. And it shows the highs, the lows, and where the day ended trading. And this is a representation of the bond market. Mortgage-backed securities are sold in the bond market, and that's where mortgage rates are determined. If we go to the right side, you can see the end here. Big sell-off. Red means money's flowing out of that bond market. Mortgage rates are going up. And basically, you can see last week, big downturn in the market. One of the main reasons for that is because of inflation. CPI came out last week, the Consumer Price Index, PPI came out. Also, the Producers Price Index. One measures consumer inflation, one measures industry or production inflation. 40-year highs. Inflation is the death of mortgage rates. We've talked about this. And basically, nobody wants to buy mortgage bonds because their return is low, because inflation's eating at their returns. Money's flowing out, and that's why mortgage rates are going up. And until inflation gets under control, we're not going to see mortgage rates come down or start to level off. And so last week, a 40-year high, and that's what caused these rates to go up. So when we talk about 100 basis points, let me put it in perspective here. If I quoted you a rate on Monday and it was a par rate or no points, no discount points, that same rate on Friday now cost you 1 point because the market got worse by 100 basis points or close to 100 basis points. So the cost of that same rate got more expensive, or I have to give you a higher rate quote to give you a par or no discount rate. So hopefully that makes some sense. So what are we looking at this week? 3 things I always give you. We're looking at the Fed, we're looking at other economies around the world, and we're looking at some data domestically, manufacturing and housing data. So let's talk about the Fed. The Fed has 2 more meetings coming up this year in November and in December. And leading up to the November meeting, they start talking a lot and having interviews, all those Fed members, and giving some insight on what they're going to do at the Fed meeting in November. Now, everybody expects them to raise the rate again, another 0.75 percentage point. Now, keep in mind, when the Fed raises that rate, that doesn't have a direct impact on mortgage rates. It actually, long-term, is going to be good for mortgage rates because it means the Fed's taking inflation seriously. And the Fed raises that Fed fund rate to fight inflation. So we expect it to be 0.75% in November. We actually expect it to be 0.75% even in December. They've got to get inflation under control. So we're going to be listening to what they're saying. Are they on the same path? Because guess what? They're getting a ton of pressure from politicians, from businesses, from corporations, from investors saying, stop, that you're hurting us. You're causing a lot of pain. Well, they are. They kicked the can down the road in 2020 when they ignored inflation, and now we're paying the piper, if you will. They have to do this to fight inflation because they don't want to kick the can further because inflation will be horrible if they don't get it under control, and this is how they do it. But everybody's starting to feel the pain and the discomfort from it, consumers and businesses, and they're putting pressure on the Fed to change course. So that's what we'll be listening for. Are they going to keep track and cause some pain now so that it gets better, or are they going to change course? The second thing is other economies. So the Bank of England has caused a lot of volatility in the market because basically they have said inflation wasn't a big deal, and then all of a sudden a couple of weeks ago they said, oh my gosh, we've got horrible inflation, and it's caused a ripple effect around the world with other economies, including our bond market, which is one of the reasons we've seen such a sell-off. And so They are going to talk about future rate hikes. Are they going to be more aggressive with their future rate hikes to fight inflation? China is starting to show some really weak economic data that they're releasing, if you believe it, and they're suffering. That economy is not doing well. In fact, it's having such a big problem that they come out with a monthly report this week, and they're just not going to produce a report. They're just not going to let us know what's going on in their economy. So it might be worse than we think. And then the ECB, the European Central Bank, is going to release some of their data. Big recessionary issues around Europe, big recessionary issues. Fuel prices expect to go up 200% by the end of the year. So they're really hurting over there, and because of their big inflationary period. And they're really heading in and already in a recession. And then the third thing is manufacturing housing data. So I want to show you another chart here that shows you the Empire State Manufacturing survey. And this obviously shows you from 20 years ago until now. And I want you to see that anytime we see this, if you can see the gray lines there, you actually see that those numbers below zero, whenever we see the manufacturing data below zero, where I've circled in the red line, that's when we head into a recession. And Empire State Manufacturing, yes, it's New York. It has a representation of what's happening around the country. And we've seen 3 negative reports from them, really indicating that we're in or headed into a recession. And typically we see manufacturing recessions before we see economic recession. So there's some strong indications here that we are headed or already in a recession. The other thing that we'll be looking at is housing data. We've got builder sentiment coming out, existing home sales coming out. We don't expect those to be very strong, and that could have some impact on rates. So we started off today actually with bond rates, the bond pricing a little better. Rates actually improved slightly. Now, it didn't make up any of the losses that we saw last week, but we expect it to be a volatile market. So we're going to start off the week floating today, but very, very cautiously watching the market with a quick move to locking if we see any changes. So if you have any questions about rates, about pricing, go ahead and give me a call. If you know somebody can benefit from this video, please forward it to them. Have a great, productive week, and I'll talk to you next week. Bye-bye.